Two semiconductor giants hitting 52-week lows as we speak are AMD and Intel Corporation. Both of these names have struggled over the past 1 year, and we'll see whether there's opportunity that lies in either of these names, or perhaps is there more downside to come. When we take a look at AMD in particular, you'll see there's quite a bit to actually like here. There's enough meat on the bone that I think you can get excited about as the valuation has come down. AMD certainly looking more and more compelling. When we take a look at Intel in particular, this company certainly has had a lot of missteps over the past couple of years and has fallen flat on its face. We'll take a look at their different business segments along with the earnings that both of these companies reported over about a week ago. And then when we get to the technicals, we'll highlight some levels maybe from a short-term trading perspective, especially for Intel, and then from AMD, we'll highlight some levels where you can maybe step in and be a buyer in terms of a long-term buy and hold. Hey guys, hope you're doing well out there. It's time to take a look at both Advanced Micro Devices and Intel Corporation. Both of these companies have a very similar sort of business unit where they're focusing on the, of course, AI data center and GPUs, but they also have a very core CPU business, otherwise known as client computing group. They're certainly big in the PC market, and so might as well take a look at both of these. And of course, the benefits over at AMD certainly are coming at the expense over at Intel, and that's been the case over the past couple of years. So we'll see whether the push and pull remains intact over at both of these names. Now, over the past 1 year, shares of AMD have significantly underperformed, down about 37%. Even over the past year to date, you're down roughly 11%. Now, you stretch it out over a longer period of time, 5 years, you've done relatively okay. In fact, you've done pretty good, up about 116%. But look, over the past 1 year, 3 years even, you are down on shares, and you're down significantly from your 52-week highs of nearly $230 a share. Now, as the stock has come down, so has the valuation, so has the market cap, and so perhaps you have a little bit more safety baked into the results over at AMD. Now, they reported their Q4 results earlier in the week with Q4 revenues coming in at $7.7 billion. That was good for 24% growth year over year, beat estimates over on Wall Street. Now, the important thing with AMD is they do give a guidance range for the upcoming quarter, and for the first quarter, AMD expecting revenues to be about $7.1 billion plus or minus $300 million. So maybe you can expect revenues to be as low as $6.8 billion, maybe as high as $7.4 billion. And consensus was right there. They were in fact underneath AMD's midpoint, as consensus was closer to $7 billion. And look, now you have analysts over on Wall Street, since it's been a couple of days, they've come in here and revised those estimates, and you're smack dab sitting at $7.1 billion in terms of Q1 estimates. That would represent 30% growth year over year. Very, very solid for a company that just grew 24% in Q4. You're expecting that growth quarter over quarter to accelerate. And certainly if AMD can come closer to the higher end of their range, nearly $7.4 billion, which they have proven that they can in the past, then certainly as you look ahead to Q2, you have an average estimate of close to $7.4 billion. That certainly should get bumped up and so on. So you have some upside over at AMD. Certainly their expectations came in pretty solid in terms of consensus. And if they can come closer to the higher end of that range, closer to $7.4 billion, well, then that can be a bullish sign. Then you also have guidance for non-GAAP gross margins expected to be roughly 54%. And when we take a look at AMD's financials, you see this company has done a relatively good job controlling costs, allowing those gross margins to expand. Now, on their conference call, they were asked a few questions which I thought were interesting, I thought to note for the future of this business, especially from a GPU and AI data center perspective. So they were questioned on the growth trajectory of the GPU business in 2025, and Lisa Su, the CEO over at AMD, did respond that the MI350 launch, expected to be sometime in the middle of the year, would act as a catalyst, with data center GPU revenues expected to grow strongly in the second half. So you have some catalysts that the second half of the year for AMD can perhaps be stronger. And certainly when we take a look at it from a revenue perspective, you're expecting roughly 22% and then 17% growth in the back half of the year. But you have a pretty wide range, I would say, from $8 billion up to, call it, $11.5 billion. So depending on how successful that MI350 series launch is over at AMD, and depending on how fast you accelerate, if you can come in closer to the higher end of this range, maybe even $10 billion in a Q4, well, then that certainly is a good sign, promising sign in terms of GPU and data center expectations for the back half of the year. Now, they were also asked about the long-term growth rates for the data center GPU business. Look, analysts are asking a lot of these questions regarding GPU is because there's some concerns that perhaps GPU demand will slow down as the hyperscalers begin to pull back CapEx, maybe in 2026. So if they're pulling back capex in 2026, will AMD feel that maybe in 2025 at the second half, or will they only feel that in 2026? And perhaps over the long term, will those hyperscalers meaningfully pull back on GPU spend? And so that's a big concern. That's a big question. That's probably one of the reasons why you've seen a recent sell-off, not just in AMD and Intel, but you've also seen that sort of stalling of growth on NVIDIA as well. Now, AMD CEO Lisa Su did reiterate with confidence that they plan to achieve tens of billions of dollars in revenue over the next couple of years, supported by a robust product roadmap. And this, again, relates directly to the GPU data center business. So that is a pretty promising sign. Look, tens of billions of dollars in revenue can certainly be meaningful over at AMD. In terms of a full year revenue figure, they put up around $26 billion in full year 2024 revenues. And so if you project maybe in a few years, you're achieving tens of billions of dollars just on the GPU business, well, that certainly has a bullish sign for AMD shares, which are closer to $180 billion in market cap. And just over the past couple of days, we got an earnings report from Amazon. And on the conference call, Andy Jassy was asked about sort of the long-term expectations in terms of cost for AI infrastructure. And this is what he had to say, which is, I think, very interesting, of course, not just for AWS and the cloud providers, but I think also for the semiconductor names. You can begin to draw some lines, connect some dots in terms of where you see hyperscalers like Amazon expect demand to be over the next few years. And the analyst over at Amazon did ask that, look, you had that DeepSeek scare a couple of weeks ago where you thought that maybe GPU spend was getting out of control. Maybe you don't need to spend nearly as much on capex for AI infrastructure because the cost to sort of train and inference these models will come down significantly. And this is what he had to say about that. So he said the interesting thing over the past couple of weeks is that people make assumptions that if you're able to decrease the cost, in this case, we're talking about decreasing the cost for inference, it's somehow going to lead to less total spend in technology. And we just have never seen that to be the case. And he provides an example that I think is very fitting in terms of cloud computing. So back in 2006, when they launched AWS, compute at that time was about 10 cents per hour. And of course, today it's much, much lower. And so people at that time thought that people would spend a lot less money on infrastructure technology as the costs for compute were beginning to come down. Well, the assumption was that maybe people will spend less money on infrastructure technology. Now, of course, we've seen AWS grow into a massive business. And so we can say confidently that that's not what happened. And so companies expect to spend a lot less per unit of infrastructure. And that becomes super useful for their business because now they can start building things that maybe they thought once would have been cost prohibitive before. And so they're seeing a very similar thing that's going to happen in AI is that the cost of inference will substantially come down and that it'll be much, much easier for companies to be able to infuse AI into all of their applications with inference and Gen AI. And then if you run a business like AWS, of course, that'll be successful for them because just like how demand for cloud computing continued to increase, demand for AI infrastructure from hyperscalers will also continue to increase. So where this relates to with AMD is because AMD has a pretty meaningful inference business. Look, their chips are highly specialized for inferencing. And if Amazon is seeing that inference costs will come down, leading to lots and lots of demand for inferencing, well, then that can be a good sign for AMD in the sense that they'll be selling a lot more of those chips. The volume and the scale for those chips will be a lot higher. Now, the give and take with that, though, is the average selling prices maybe on those chips could come under pressure. Certainly, if you have more competition, also that can sort of be a drag on margins. But in my opinion, I think if you have demand for AI infrastructure, demand for training and inferencing continuing to increase over time and not actually decrease, that is actually a good thing for these chip designers like AMD and NVIDIA because more demand means more volume, and more volume generally tends to offset the lower average selling prices you continue to get from just the development of technology. At least on the trailing edge chips, you'll still have very high prices on the leading edge chips. Now, in terms of the different segments over at AMD, one thing to note is you do have a pretty well diversified business. And so look, with NVIDIA, you have a very, very large push towards data center where that makes up a huge, huge majority of their revenues. Over at AMD, you don't have nearly that heavy of a mix in data centers. Look, it's certainly still big over at AMD with nearly $3.9 billion in net revenues in the most recent quarter. You also have a pretty large CPU business in terms of client computing at $2.3 billion. Both of these businesses growing well over 60% on a year-over-year basis, and that is impressive to see. Even quarter-over-quarter, they're both growing pretty meaningfully. Now, the important thing though is you do have very meaningful operating incomes coming out of your data center business, as well as operating income there was up 74% on a year-on-year basis. And similar story on your client computing group. Last year, you were basically break even on that. Now, off of $2.3 billion in net revenues, you're netting out about $500 million in operating income. Again, higher meaningfully from just a quarter ago. Now, with AMD, like we said, you do have a gaming and an embedded business. These tend to be a bit more cyclical and of course, less reliant on hyperscalers like Amazon, Microsoft, and Google. You're selling a bit more into the enterprise and into the consumer hands at this point. Certainly you're well off of a console refresh cycle and you don't really have too much in PC gaming demand really there. And so you're down 60% on your gaming net revenues, huge declines there, and you're down nearly 80% on your operating income side there. Similar story in embedded, as you're down 13% on your embedded revenues and down nearly 21% on those embedded operating income. Now, with the embedded side, you are seeing some flattening out of your revenues on a quarter-over-quarter basis, which could be a promising sign, but still year-over-year, you're down pretty substantially. Now, the important thing with AMD though is the data center and client computing group is starting to make a bigger piece of the pie over at this company's revenues. And certainly if data center and AI can continue to be hot, well, then that can continue to be strong over at AMD. But all things considered, look, you always have a bit of push and pull with AMD. Maybe when data center is hot, gaming wouldn't be so hot. And then when you have a new console cycle in a couple of years, maybe data center demand wouldn't be nearly as hot at that time. Now, overall though, you do have a lot to like over at AMD. They had revenues around $7.7 billion, kept cost of sales relatively in check at $3.5 billion, up same time from last year of $3.2 billion, but you grew your revenues by nearly, call it $800 million. So you're growing your top line faster than you are growing your cost of sales. That allows your gross margin to increase from 50% up to 51%. Keep in mind, in the guidance, they did guide for non-GAAP gross margins come in around 54%. So you are continuing to expect gross margin expansion over at AMD. Now, they also kept R&D expenses relatively in check from 1.6 up to 1.7. Marketing G&A basically flat, and then you have some restructuring charges you do recognize in this quarter. All things considered though, for the full year, $1.9 billion of operating income. That's off of $26 billion of net revenue. So you're not looking at huge margins, certainly not looking at margins like NVIDIA. And even when your gross margins are 50%, certainly nowhere close to NVIDIA's nearly 70% gross margin. But hey, some of that can certainly be due to the fact that they're seeing Intel fall flat on their face. So maybe they're kind of undercutting Intel's prices, hurting margin in the short term to eventually take more market share in the long term. The other thing though is you have perhaps more market share available to be taken away from NVIDIA, because NVIDIA's gross margin is closer to 74%. I think some of that maybe has the opportunity to come under threat, especially if AMD's MI300 series hits the mark in terms of AI GPUs. All things considered though, you do have basically growing revenues, growing margins, growing operating income along the board, and that certainly is a good sign, especially because you're also anticipating further growth ahead, nearly 30% in the upcoming quarter. Now, from a balance sheet perspective, you do have pretty good balance sheet over at AMD, sitting on roughly, call it $5 billion in cash, another $6 billion in accounts receivables. They do have a fairly large amount of inventory sitting on the balance sheet, $5.7 billion last year. You were closer to $4.3 billion. Now, keep in mind, maybe some of this is front loading from some tariff talks, or perhaps some of it is just due to the fact that they're seeing very good demand on their MI300 series. So maybe that could be a little bit of that. But if you certainly do have a lot of gaming or embedded inventory buildup here, that wouldn't be a good sign. Now, in terms of liabilities, you don't have a ton of long-term debt, about $1.7 billion of long-term debt. They have no short-term debt over at AMD, so you have a fairly well-capitalized balance sheet with more cash than debt. Now, from a cash flow perspective, we'll take a look at the full year cash flows. Net income of $1.6 billion. You get to add back some stock-based comp, some depreciation. You get to net cash provided by operating activities, roughly $3 billion, pretty much 100% growth on a year-over-year basis. You are growing your cash flows very, very nicely. Now, this company isn't trying to build foundries or fabrication facilities, and so your capex is very controlled at around $630 million, leaving them with about $2.4 billion of free cash flow. So they put some of that away in terms of short-term investments, and then they look to pay back some debt that they did roughly to the tune of $750 million for the year. They are buying back a little bit of the stock, but keep in mind for the full year, just $900 million in terms of stock buyback, and you had close to $1.4 billion in stock-based compensation. So some of that stock buyback, in fact, all of it, is pretty much just offsetting that dilution. But look, regardless, you do have a pretty good cash flow statement over at AMD. You are growing those cash flows, and certainly if you can expect AMD to hit these growth rates, even come in line with those growth rates, I think that's a very promising sign for this business that is continuing to grow margins, keeping costs in check, and while taking market share away from players like Intel especially. Now, speaking of Intel and moving on to Intel Corporation, shares are down nearly 55% over the past 1 year. You slice it any way you want over the past 5 years, 10 years, year to date, you are down pretty substantially on your shares of Intel. Your forward earnings also aren't all that cheap. Now, that's because Intel's earnings have significantly declined as the years have gone on. And so anytime you have your earnings decline, yeah, the share price will follow, but you're still not looking very cheap on shares of Intel, despite the huge drop over the past couple of years. Now, Intel also reported their earnings about a week ago with revenues coming in at $14.26 billion. That was a decline year on year of nearly 7%. It did beat estimates though by around $500 million. So that's one thing. Intel has been getting closer and closer to those analyst estimates. At one point, they were missing those estimates by a huge margin. Now, they also did guide for first quarter 2025 revenues to be in the range of $11.7 up to $12.7 billion. Consensus was still higher at $12.9 billion. So look, Intel still coming in underneath first quarter guidance, but at least the difference in terms of what they're guiding and what the street expects is beginning to narrow pretty significantly. Now, as you look ahead over at Intel, you don't have a lot to be excited about, unfortunately. Over the next 12 months, you're looking at just basically low single-digit growth over the quarters. As you look into 2026, that growth may accelerate to high single digits. Now, the reason I said may accelerate is because this company hasn't proved out pretty much anything over the past couple of years. And so you would have to wait and see whether Intel can really fix its core problems in order to accelerate growth sometime in 2026. And from an earnings perspective, you're pretty much expected to call it generate about 50 cents in EPS for the full year. And so on a share price of close to $20, that gives you that nearly 40 times forward earnings multiple. So from a growth rate and a earnings perspective, there's certainly not a lot to be excited about over at Intel. But with that being said, you could have some catalyst for some positive moves over at Intel, especially from a stock perspective coming up. Now, the first thing is, of course, you had Pat Gelsinger leave the building, and you currently have two co-CEOs in the interim taking his spot, but you do have a CEO search that is ongoing over at Intel. And so if they can find a very good CEO, maybe someone from industry, maybe someone from within that they can promote and that Wall Street is a fan of, well, then that can certainly be bullish for the stock, can shoot the stock up, at least in the short term, based on that CEO catalyst. You also do have the fact that Intel is trying to shop some of its different segments like Mobileye and Altera. And so if they can get some cash added onto the balance sheet by shopping out some of those segments, well, then that can be another bullish catalyst over at Intel, at least in the short term. In the long term, I still don't think there's actually a lot to like here in terms of their business. Now, they have three different segments. The client computing group, this is really the CPUs. When we took a look at AMD, this was sort of their client segment. They also have data center and AI. This is sort of GPUs. And then you have networking and edge computing. Now, the client computing group is holding relatively in line. I mean, you did see revenues decline there from 8.8 billion down to 8 billion. You also saw your margins on your operating basis contract from 40% down to 38%, but it's nearly not as bad as you would expect. The client computing group relatively still remains a bright spot over at Intel. It's how they're generating the vast majority of those operating incomes. They're trying to keep their overall business at a break even, and the client computing group is contributing to the vast majority of those operating incomes. So you're not seeing huge declines on the client computing side. But look, when we took a look at AMD, I mean, you saw your revenues grow nearly 60% on the client side. So your operating income grow nearly 700% on that side. And so Intel certainly is giving up some of that market share, in fact, a lot of that market share, to AMD at a time where your core CPU business still remains relatively strong. Now, from a data center and AI perspective, I mean, Intel pretty much has no pull in this part of their business. As you saw revenues go from 3.5 down to 3.4 billion, you're also seeing huge declines on your operating margin side from 21% now down to 7%, just 7% in the most recent quarter. You basically are on a break-even basis on your data center and AI business. They do say they're working in an increasingly competitive roadmap, but look, we just saw that AMD is also working in an increasingly competitive roadmap, and while their data center business is up 70% year over year, whereas Intel's was actually down on a year-on-year basis. Now, the networking and edge group continues to also stay relatively flat, I'd say, from a revenue perspective, 1.5, call it up to 1.6 billion. You are seeing margin expansion there, pretty strong, from 7% up to 21%, and that is translating over to operating income, as now you're generating about $300 million from operating income on that side. So the networking and edge, again, relatively bright spot in terms of growth rates. And then you have client computing basically being the bread and butter over at Intel, staying relatively stable. It's basically the data center and AI where Intel is losing a ton of market share, falling flat on their face and missing the curve. And with that being said, I think it's time to take a look at the foundry business, which basically remains an absolute disaster. You have revenues continuing to decline from 5.2 billion, now at 4.5 billion in the most recent quarter. Operating losses continue to grow from a loss of 1.3 billion, now at a loss of $2.3 billion in a quarter. And so you're still negative on your operating margin perspective by close to 50%. They did give a guidance figure in the form of being focused on operating income break even by the end of 2027. Guys, that should tell you you're pretty much looking 3 years out in order to just break even on the Intel foundry business. You have all of 2025, 2026, and 2027 in order to just pretty much get to operating margins of 0%. So that is a long roadmap, and in that time, you'll probably have the leader in the space, TSM, continue to develop and open more foundries, get vastly more successful. The only reason I think Intel's foundry business has survived this long is because of the huge amounts of funding they've received from the CHIPS Act, which in my opinion should have gone elsewhere to other companies, because, well, Intel is absolutely burning that money. And at one point, in fact, if you didn't know, AMD itself had a foundries business. Back in 2009, Global Foundries was a spin-off from AMD. And so about 14 to 15 years ago, AMD realized that, hey, you can't have a company that does the designing of those chips and the manufacturing of those chips all in one. You kind of have to separate out those businesses, simply because how capex intensive a foundry business is. And so they spun off Global Foundries. Now it's a standalone company. I believe it's public, in fact. And well, we know that it hasn't done great, especially against the likes of TSM. I think that is the road Intel is also going to be going down. Eventually, I fully expect this company to spin out their foundry business to compete against TSM head to head. But until then, Intel will continue to fund it and basically bleed money. And by the time Intel does realize they need to spin it out, they'll probably be about 10 to 15 years behind the curve. Now, from a financial perspective, I mean, it's an absolute disaster. There's not much to like here. You have your revenues declining year over year. On top of that, you have your cost of sales actually increasing year over year. And so your gross margins, both from a dollar and percent perspective, coming down on a year-on-year basis. Now, your R&D did come down from $4 billion, call it, down to $3.9 billion. G&A also coming down as well. And then for the full year, you recognize nearly a $7 billion restructuring charge, largely because of the incompetency of Pat Gelsinger to control the expenses over at the business over the past couple of years. And so for the full year, you generated nearly $12 billion of operating losses. I mean, that is gigantic. Even in 2023, you were pretty much at break even on this business. And well, in 2024, it was an absolute disaster, pretty much a year to forget over at Intel. And well, your net income was down $20 billion negative on a full year basis. So very disappointing to see from Intel. They've certainly lost the crown on the CPU and client computing business, let alone the AI and GPU business as well. Now, from a balance sheet, you also have concerns over at Intel. You're sitting on basically, call it 8.2 plus 13.8. You're about $22 billion in cash and cash equivalents. Now, normally that would be pretty good for a company valued around, call it $80 billion in total. But with Intel, you do have about $3.7 billion of short-term debt, but an additional $46 billion of long-term debt. So you're balanced out a lot. In fact, all of that cash with debt on your balance sheet, and your total current assets coming in at just $47 billion. So in fact, you have more debt than you have all total current assets over at Intel. And that's again, concerning. I mean, you don't have a lot of leeway left with this business. That's why they're trying to shop Mobileye and Altera in order to raise capital, raise cash, in order to shore up that balance sheet. You also likely will see further dilution if the company needs to raise further capital. Now, one thing that can benefit Intel is lower rates. Look, if you get lower rates, this nearly $46 billion worth of debt does become a lot easier and cheaper to finance and service. And so some of that can benefit Intel if you do move into a lower rate environment. Now, from a cash flow perspective, about $20 billion in net income losses. That translates into $8 billion of total operating income. You did get to add huge amounts of depreciation, stock-based comp, also restructuring charges that necessarily weren't cash expenses. And so $8 billion of operating cash flows. Now, unfortunately for Intel, they are spending a gigantic amount in trying to build out those foundries. And so their capex is close to $24 billion for the full year. And well, that doesn't leave them any money to do a buyback. They've cut the dividend. They can't pay back debt. And so Intel really is no financial position to continue this sort of cash burn over the next couple of quarters and years. They have to figure out a way to grow those sales, get better margins, and continue to grow those cash flows. Because if they don't, this company, no doubt about it, will go bankrupt. And so from a long-term perspective, I think these financials are absolutely dismal. And until Intel can prove out that they can spin off that foundry business, that they can sell Altera and Mobileye, that they can get a competent CEO at the desk, I think this company is an absolute no touch for me, especially at a time where the competitors like AMD are continuing to grow and take market share away and guiding for very strong results as well. Now, from a technical perspective, we'll take a look at AMD first. You are certainly in a downtrend. Now, with AMD, you tend to make these sort of huge downtrending moves every now and then. I mean, you had a huge uptrend, and then you saw that sort of reverse from, call it 2022 to the end of 2023. And then you saw another huge rally, and now you're seeing that followed up with a downtrend of lower highs and lower lows. So if you do want to pick shares up, if you do want to step in within this downtrend, I mean, your first level is probably $3 or $4 underneath here at 104. This isn't a point I would get too excited to step in. You are near the bottom end of the range, and so at times like this, you could perhaps see a reversal. So if you want to play the swing on that, you could absolutely do that, but I would set a stop loss pretty much right here at 102, maybe a bit lower at 101. So if you want to play the reversal here, you're looking for a bounce at 103, back up to, call it the 130s, maybe as high as the 140s. And so with that, you set a stop loss. Now, in case you don't want to step in and buy the dip on a stock heading lower, which, look, I wouldn't blame you if you're a long-term buy and hold investment, you want to make sure AMD confirms that it's broken out of this downtrend. And the way it does that is it'll come up here and needs to decisively break out of this lower trending channel, come up all the way up here, probably to the 145, and then come back and ideally back test maybe the top end of this range. Maybe it comes down a bit lower into the 120s. You want to back test a previous level of support or resistance, and from there you move higher. So really, you want to see this sort of pattern come show up for AMD. And at this point where you're once again reversing after a retest, that is where you step in and be a buyer in shares of AMD. That's where you know the downtrend is over and you're beginning to make an uptrend. But until then, I think if you're a long-term investor, you could maybe step in at this point, but you have to be very okay with seeing red on your account, because look, if AMD breaks through this $103 lower support, well, then you're probably coming much lower down here at basically $90, $95 a share. And seeing the huge moves that we saw in the market, especially when the DeepSeek news came out, certainly wouldn't be surprised if you see huge moves like that with AMD as well. I do like this one for the long term. I think the valuation is also quite compelling at this point. You are in a downtrend though, which makes it difficult to step in from a technical perspective. But if you are a long-term buy and hold investor, you don't mind seeing your account or your positions go into the red, well, you could certainly take a crack at AMD here. I would say though, if you are buying AMD, you probably should have a pretty good position in Nvidia and Broadcom and TSM, because those, in my opinion, still remain as a better and overall market leader in the space over AMD. And in terms of Intel, you do have a level of support with Intel down here, basically where you are with the stock at $19 a share. You're not really in a well-defined downtrend, but you have seen these huge gap downs. At some point, you're hoping that Intel at some point comes back and fills these gaps all the way up here to the $30 range. I think you could have some catalysts like a new CEO announcement or perhaps the fact that they're selling Mobileye and Altera, and if they can get a good price for that, well, then that can certainly be beneficial for the stock. But I mean, for the past basically 20 years, 25 years, you've done nothing over at Intel. And if it breaks this nearly $19 support, I mean, you ideally want to have a stop loss here if you are holding shares of Intel, because if you break that, you're coming all the way down to, call it $10 a share. And well, that is a nearly 50% drop from where we are currently. So with Intel, you're pretty much just banking on the fact that the new CEO, whenever that gets announced, is able to turn things around. Or if you are holding shares of Intel and you have an ultra long-term perspective on it, well, then you're hoping that the foundry business can turn meaningful amounts of operating income beyond 2027, and that the GPU business and the data center business over at Intel can begin to put out a meaningful product. That was my take on both AMD and Intel. AMD I do prefer for a long-term buy and hold. Intel, if you are looking to make a quick buck, I'd be sure to have stop losses and well, track the news very carefully. It's not one that I'm particularly interested in. AMD I do have on my watch list. If it continues to move lower, could get a bit more enticing as well. Let me know your thoughts on these ones in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.